Jeff, Zach, thanks for joining me.
Hey,
Hey,
Steve.
Steve.
Hey, talking today, getting a little wonky and in the weeds about real estate distress at the large banks versus regional banks. And the story we've been hearing is the regional banks are at more risk, but the folks at MSCI Real Assets dug into some of the data and found that in terms of maturity risk, what's coming due, more exposure to the big banks. National banks held 29% of the value of tracked office debt that matured last year and have 20% of the debt due this year. Regional and local bank share was 16% last year and 13% this year. In addition, big banks are having some problems in terms of loans tied to properties and tend to be leased to third parties for CRE loans involving properties that are owner occupied and held by banks with over $100 billion in assets. More than 4.4% were delinquent. So that was this area that had a little bit more risk, and it turns out the big banks had more exposure. Some of your thoughts to just how this kind of maybe goes against the narrative that all the problem is at the small regional banks.
Look, I think it's kind of interesting. To some degree, this is, really exactly what the point of, Dodd-Frank was about. It wasn't about just residential lending. It was about all types of lending. And what it also brought out is, was bank stress testing. Banks were forced to go and look at their portfolio assets on a quarterly basis and then stress the portfolio by losses or predicted losses and how it impacts their capital. I think in today's world, this is probably more of a doom and gloom outlook to get people to click onto it. But banks are operating at a with healthier capital these days than what they were in the past, and that they're willing and ready to sustain some losses. Now, I think on the other side of it is, they're looking at, did they actually right size the loan in the when it was first put out, and they're having to look at whether or not they're going to be able to either get refinanced out or make some concessions to refinance some of those loans internally.
I would add as well that 4.4% delinquent, I think, is within the confines of what they underwrite for. So I don't think they're actually exceeding what they've already forecast or underwritten. To Jeff's point, I think they're capitalized well. I saw this morning JP Morgan had record profits. If they're suffering as badly as they were, they wouldn't buy First Republic Bank, which was a failed bank, and had all of these assets. There were all these delinquent assets that would drag the bank down. I mean, if anything, it's quite the opposite. What I also do think that you're seeing is that a lot of these loans were originated 5 and 10 years ago at much lower interest rates. When it comes time to refinance, you're at a higher interest rate, which is going to
Yeah.
cause a lot of short-term stress and dislocation. I don't think that's permanent. I also think banks have been willing to work with lender or borrowers on that kind of a basis. And what they're finding is, as the stress from the Fed and interest rate policy kind of relaxes a little bit, you'll see the valve get released a little bit, and a lot of these loans will then all of a sudden become current. So
Yeah.
I don't see this necessarily as bad as it's made out to be. I kind of agree that it looks like it's more let's show you all the storm clouds. Let's 6 o'clock nightly news, everything that's wrong in the world, instead of the sunshine and rainbows that might actually end up occurring.
Yeah, I mean, and
Yeah,
I would add to it on the side of the 4.4%, like you indicated. When I worked at a bank, I designed and created that bank stress test policy, and one of the things that my actual model had in it was actually sustaining losses that were 10, 20, 30%. So,
Yeah.
and seeing the impact, 4% is actually really low in a lot of ways. So I think that this, again, this isn't as bad as it is made out to be, but and if you're being honest, and you got a bank with trillions of dollars in commercial real estate, 4.4% can still be pretty significant. But it's not as high as what a lot of these banks are stressing. Their models are stressing.
yeah, and I think I would also point out two things. Uh, One, yeah, the regional banks per se aren't in that bad of a situation, but there is probably more risk to a regional bank having some issues and seeing that in the headlines versus the entire class versus the really kind of mega banks. And the other thing I'd say that we've already kind of come see in play here is the mega banks basically are operating with a get out of jail free card. They're considered,
Yeah.
systemic risk. The government will step in and it will save them, while the regional banks are not considered key to the system. And we've already seen that the government will allow those banks to fail. Now they'll probably backstop them. They might require one of the bigger guys to buy them out and to merge them, but the smaller players will be allowed to die. And the larger players are working with an implicit guarantee from the federal government to be covered. So, this article, this data doesn't really point to that, but I think that's a pretty big thing that's going on that quite frankly has nothing to do with balance sheets or the markets, really. It has to do with federal government policy.
Well, I think
It's one thing
that'll-
that's interesting that you said there, Steve, is that the implicit get out of jail free card, the little banks will fail, the big banks will buy them. Who foots the bill for the big banks buying them? It's basically the government writing them a check to then buy the little bank anyway. So it's kind of, why wouldn't they just give the money to the little bank? No, it's a weird game going on right now.
I think I would, I'd also add to it. It's a political year, so depending upon who falls in office and what happens, you could see a change in how things are done.
Well, that's probably a different video for a different time.
Yeah.
I wasn't meaning to transition this to politics, but it was brought up, and depending upon who gets in office and what happens, it could be, could be a different story.
I think
Sure.
that will probably get covered sometime in the future. Too big to fail seems to have been a theme since 2008 that comes up from now and then, and probably worth our attention at some point. Probably be in the headlines at some point. Until then, thanks for guys' opinions and views. If you enjoyed the video, give us a thumbs up. Click subscribe if you haven't. Visit our website at selectfincap.com and register to get a look at exclusive investment opportunities in the commercial real estate space. Thanks a lot.
Thank you.
Thank you.